Okay, yeah, whenever you're. Hey, Jim, you're up. Take it away.
Okay, yes, good morning. Good to see everyone, and I hope you're all well and taking care of yourselves. How much time do we have for my presentation?
All of 20 minutes. Yeah, you can go a little long if you need to.
Sure, great. You should all have received the presentation in advance. I'm going to spend a little more time on the non-salary defined benefit pension plan. It's the first plan that we present in the materials, and I'm just spend more time on that one simply because all three accounts are managed identically. So what you'll see here, as you look at page 1, you'll see the asset allocation as of the end of June. We show the policy ranges, and we show the actual allocations as of the report date. So there's a little bit of cash in the account, and what's going on there is we need to keep some cash around for liquidity purposes to pay benefits, of course, and also we had sold some cash sold some bonds, I should say, to raise some cash right in the thick of the panic in the market, where there was some discussion of there being a lockdown and not having access to the capital markets. Subsequent to the report date, we have that most of that cash has been reinvested in bonds. If you look at page 2, we take a look at the equity blend as of June 30th. We're roughly 30% international, 70% domestic. The domestic, you can see, is roughly half invested in, or of the domestic, it's really about 2/3 is invested in large cap domestic with a tilt towards value stocks. And then we have mid cap, small cap, and micro cap. So the portfolio has what's referred to as factor tilts, and the factors are value and smaller capitalization stocks. Why is that? Well, this is a pension plan. It's a long-term investment horizon, and history has shown that value stocks outperform growth stocks over time, although that hasn't been the case in recent years, and that small cap stocks outperform large cap stocks over longer periods of time. And again, up until just very recently, we haven't seen that. Large cap domestic equities have been the best place to be for the last 5 years or so. Looking at page 3, we're looking at the bond component, and here we've been very conservative. This is the conservative part of your portfolio. So we've maintained very high average credit quality, and we've maintained an intermediate duration. We believe that the bond market has a lot more downside risk than upside opportunity at this point. And what we're referring to here, which we'll talk a little bit later, is, as you know, the federal government has in a variety of different ways, has been printing a lot of money and putting a lot of money into the market to buy bonds by the Federal Reserve and through the CARES Act, which is at $3 trillion and counting. And as you know, we're right on the verge of having another federal spending spree, if you will, and more money getting pumped into the economy. Now, we certainly are very well aware that and agree with that there's something needed to be done, and it was a good thing that that our Congress got together, which had been very divisive prior to that act. The president signed it into law. All of that is good. It was really what the economy needed. We're going to show some of the benefits that are associated with that. But coming out of this, after we get out past this pandemic and the economy gets more normal, whatever that's going to look like, it's very likely that we're going to have a lot of cash out there. And so, like anything else, when there's more supply than there is demand, the price drops. That's a nice way of saying inflation. We could have some inflation risk in the market. So with bonds, we want to be high credit quality, intermediate to shorter duration, and that's what we've done. Look at page 4. There's 2 time periods here. The left-hand column is the second calendar quarter for 2020. And then the right-hand column is since Alesco's inception, which is calendar year, January 1st. So you can see the quarter was very strong with an investment gain of $3,763,000. That number can be found just above the blue line in the middle of the page. So also, I think it's important to take a look at the cash flows that in the endowment. So you started with just under 28 million in the quarter, 400,000 roughly in contributions, 758,000 in withdrawals. So there's more distributions that are taking place than contributions. You'll see the income received 180,000 roughly, and 3.6 million in capital gains. So those two numbers, the income and the capital gain number, those total to the investment gain number you see there, the 3.763 million in gains. So a 13.57% return for the quarter, a very strong recovery. We'll put that in context of the capital markets in a minute. Kind of good news, bad news story here, that what you see is that on a year-to-date basis, we're pretty much at a break even. So the first quarter, particularly late February and March, were very difficult. You all know and are familiar with that. We went into a bear market, went into a recession, and then we've had this very dramatic recovery. So we're very close to break even as of June 30th. As of today, I just looked at the account value today. It's up 3.8% for the month of July so far. So on a year-to-date basis, as we speak, you're up about 3.5%, maybe just a little over 3%, like a more accurate number. And so what that gets you, if we were to annualize that, we'd be getting close to what our actual return expectations are. As you know, we're not going to be making that number on the button probably ever in any year, but they're going to be, it's how we do over time. And we believe we have the portfolio positioned to do well over time. You'll also going to hear me talk I think most people find it to be rather optimistic, but we have I think a more sanguine outlook for where our economy is headed over the next 12 to 24 months than the financial media in general is presenting. And it's not just a reflection of anyone's personality. It's looking at the data and feeling that the data looks pretty good. Page 5, we show the same two time periods, and we show the different major categories for your portfolio. So we're showing equities. So the gray shaded line for equities represents how your portfolio performed. And then underneath that, we show major market indices. And so same thing with fixed income and real return. So if you look at the equity numbers, if you look at the right-hand column since inception, you'll see that large cap domestic equities with the S&P 500 as a proxy for that category, down 3.08% for the first 6 months of this year. Far and away, the best performing place to be relative to mid cap, which is the S&P 400, small cap with the Russell 2000. And then there's two international benchmarks. The EAFE, EAFE, that's the European Australasia Far East Index, and that represents developed international equities. And then emerging markets is the last. So as I mentioned earlier, we're happy to report that the largest piece of your portfolio is in large cap domestic equities, but we're not exclusively in large cap domestic equities. And relative to how the market overall is allocated, we're actually overweight in mid cap and small cap stocks, which on an inception to date basis had trailed. If you look at the second quarter, what we see here is what we believe is the beginning of a very healthy trend for the markets, and that is we're seeing a rotation, more money rotating into mid-cap and small-cap stocks. You can see that in the second quarter, those two categories outperformed large cap We're seeing the same thing play out here in the month of July so far. You see your bonds are very much in line with the Bloomberg Barclays aggregate index. And then the real return assets, which as we speak is really only in TIPS, Treasury Inflation Protected Securities. We had for a short period of time, for a few months, we had some commodities in there, which is basically 50% energy, and we had real estate, both domestic and international. We rotated, we've moved out of those. So real return assets, the whole purpose of that category is to be an inflation hedge. We think that commodities, particularly energy, has lost that characteristic. Given how much is available right now, how much supply is available, and how much can come online relatively quickly, giving modern drilling techniques, specifically hydrofracking and horizontal drilling. So we backed off of that. You still have commodity exposure, of course, because you own emerging market stocks, you own U.S. companies with all kinds of energy, but we don't have any concentrated positions in commodities. And real estate, we're reviewing what we're going through right now. Some of us calling in from home, many of us working virtually. We see this as a paradigm shift for several different major parts of the real estate market. Certainly commercial office space is likely to be soft for quite some time to come, and it could be permanently changed. And retail, we would argue, is permanently changed. As one person put it, this country has compressed 5 years of digitalization of our society in just a few months, where we're all comfortable now, doing these WebEx calls or Zoom calls, whatever we're doing, working virtually. We've all learned how to order online. So things have changed, and you're seeing that right now in the retail space in a big way. Ann Taylor declared bankruptcy yesterday, and others have declared, and there'll be more to come. Just one more slide here, and then I'm going to pause for questions on page 6. So one of the issues that we're concerned with large cap domestic equities is how concentrated that part of the market is. And we show that on page 6 here, where 5 companies represent over 20% of the capitalization of the S&P 500. Now, to put that in perspective, the S&P 500 is about 78% of all the money invested in stocks in the United States. So you've got, in effect, whatever that math is, 18% of all the money that's invested in stocks in U.S. companies in just 5 companies. So that's very concentrated risk. And those are good companies. When you look at the names on the list here, they're great businesses and they're doing very well. And we hope they continue to do well. But we certainly don't want to be overweight in that part of the marketplace, because there's always a day of reckoning. Where you're likely to see it in this space, because they are good businesses and they are very well managed, is you're likely to see the issues come from a regulatory standpoint. It could be antitrust actions. There's a variety of different things that could happen. And also we could be going through a significant change in the political environment in Washington, D.C. If there is a shift decidedly to the left, it's not going to be as favorable for big business. And in all likelihood, the bigger you are, the tougher it may be on you. So we have to be, we just don't want to fall in love with yesterday's heroes. We want to have an allocation there, which we do, but not get crazy. So let me pause for some questions.
No, I think we can keep going. Very good, Jim.
Great. So let's jump ahead then to page 9, which is the salaried DB plan. And the next few slides, 9, 10, 11, you're going to see those are all virtually identical to what we saw in the first plan. And as one might expect, when you turn to page 12, the results are also virtually identical. We're managing all three plans the same way, they have the same asset allocation, and so we should see very similar results. Also for the salary plan, nice move in the month of July, up 3.9% so far. The value in this account as we speak is at 31.6 million. And then if we look at page 16, we move into the Utica employee plan. Again, the same asset allocation across the board. And that's true for the equity piece as well on page 17 and fixed income on page 18. And then the results on page 19 are also very close to what we saw in the other two plans. And for the month of July, this account's up 3.7%. All very much running in tandem. So any questions about the results? If not, I'm going to just spend a few minutes talking to the slides we have in our capital markets review, which starts on page 23. But I'm going to actually jump ahead to page 25. The COVID-19 page is something I'm sure everybody's familiar with. Been reading a lot about it, hearing a lot about it, and it just looking at the trends. But page 25 is, many of you may have asked, what's going on? How is the stock market doing so well with all of these bad headlines? And so this is just a little slide that reminds us that that this is a I'm sorry.
It's page 24 is the COVID-19 page.
Yeah. So and on page 25 is the stock market. It says the stock market anticipates the economy. And that's really the response to, why the market is doing so well. The stock market is looking ahead. It's looking at economic activity for 2021 and beyond. And the stock market is a discounting mechanism, meaning from an economic standpoint, it's going to look at economic data in future years and discount that data using current and anticipated rates of interest. And interest rates, as you know, are very low. But not only are they low, the Federal Reserve has said that they're not even considering raising interest rates at this point in time. So that is an indication that rates are going to stay low for some time. That means that when investors are discounting cash flows and corporate earnings from in future years, those cash flows and earnings are worth more in today's dollars than if interest rates were projected to be higher. And that's why the stock market has moved up as much as it has. Investors have pretty much written off 2020, but are looking at the other side of the valley, looking across the valley and saying things are going to be better in the future. So 26 is a very timely page 26 is a very timely slide. You may have seen yesterday the unemployment claims hit 1.4 million again. So it's the first increase we've seen in a while. That, of course, has to do with the lockdowns and the changes that are being made in the quote unquote hotspots around the country, where some areas had opened up and people became a little too cavalier as it relates to the virus. We saw infection rates increase, and in some cases we've seen significant increases of hospitalizations and deaths. And so many of those areas are now slowing down. They've changed their thinking, and with that occurs more furloughs and more cutbacks of employment. You are probably aware, if you look at the lower chart on page 26, that the vast majority of the headcount reductions have taken place in two sectors, the entertainment and leisure sectors. And if you look at the impact that has from a demographic standpoint, that's a large percentage of people who are employed in the entertainment and leisure sector do not have higher levels of education. And so the furloughing and the cutbacks have occurred with people who have a lower level of education. And so it's had a disproportionate impact on that group. On page 27, we get into the more optimistic, some of the more optimistic data that I referenced earlier. What this chart shows is that although we had a major decline in the outlook for economic activity, both in manufacturing side of the world, of the United States economy, as well as the services side, you've seen this giant recovery take place just in the last few months. This is a very important data set with regard as it relates to future economic activity. When we see the survey data from business managers turn to positive, this is almost always is a very good leading indicator. So we recognize that some of the things I just talked about, could throw a wrench into the works, but generally speaking, it looks as though things are improving in the U.S. economy. What's required for the U.S. economy to really get going again and really have very favorable expansion is for the U.S. consumer to feel good about the future and have the resources to spend. On pages 28 and 29, we address both of those. On page 28, what you'll see, the top slide there, the top chart shows that household debt burden, which is looking at debt payments as a percentage of disposable income, is at a 30-year low. That means that people have the ability to spend money and to take on debt, whether it's a car loan or a mortgage or whatever it may be. And then the savings rate has skyrocketed. And so you say, what the heck is going on there? Well, what's happening is if you take what we talked about a little while ago, if you look at the leisure industry, the entertainment industry, and people who have had those were people who had lower levels of pay generally. And then you look at the CARES Act and the unemployment compensation that's associated with that act. Generally, people who had incomes of below $50,000 a year are getting paid more not working than while working. And so that has put a lot of money into people's pockets that they didn't have previously. And there's a lot of people haven't had any place to go. There was not a lot of socializing, not a lot of places to go, not a lot of retail places open. And so the savings rate moved up very dramatically. So part A, consumers having the resources. Yes, they do. And then part B on page 29, the consumer's mindset. And so the consumer confidence numbers, while they drop dramatically, you'll see that orange line. The green line is expectations. In other words, how they think things are going to be in the future has remained very steady. So longer-term consumer confidence is still very high. And the most tangible example we can show you of the consumer wanting to get back into the game is pending home sales, which has jumped up dramatically. Now, why is that? Well, you can buy a home very comfortably in a non-threatening COVID-19 way, right? You can look online, you can look at the pictures of the home, you can price the whole thing out virtually, and when you go to visit it, it can be done in a social distancing fashion. It's not like there's 30 people coming into that home at the same time. You can come in, it's comfortable, and so what you're seeing some tangible support for the idea that the consumer is going to start spending again. And then the last couple things I just say on page 30, if you haven't seen this data before, I find it fascinating, and that is that U.S. travel, people want to get out and do things. They're just not flying, and they're not taking mass transit. What are they doing? They're getting in their cars, they're getting in their campers, and they're driving places. And so they're out doing things. Again, another indicator that the consumer wants to get back in the game. And then the bottom slide there, you're looking at hotel and dining down. Not a surprise, of course. But Airbnb last week, if you saw that news, they had their first 1 million booking day. They have a million Airbnb locations were booked in one day. So consumer wants to go someplace, they find an Airbnb, they're simply they're doing that. They don't want to be in a hotel lobby, they don't want to be in an elevator, they feel comfortable in an individual residence. I talked briefly about the Federal Reserve on page 31, but Federal Reserve has said they will do whatever it takes to get this economy back on track. That's music to stock investors' ears, and in the short run, it's music to bond investors too, because we've seen interest rates drop. So bond markets rallied very nicely. Longer term, however, we discussed the inflation repercussions of that. Let's just jump ahead. We talked a little bit about oil. Let's jump ahead to page 34. This is just I know I'm probably preaching to the choir here, but on page 34, what we're doing is we're just taking a look at the importance of diversification, because the markets shift back and forth in terms of what's in favor, what's out of favor. If you look at the top chart on page 34, the orange bars represent the 10-year returns for major categories for the stock market. And so you can see that for the 10 years ended June 30th, 2010, emerging market equities were the best performing part of the stock market by a long shot. Mid-cap and small-cap U.S. stocks were second and third, and then developed international, and then may seem impossible, it's hard to believe, but believe it or not, large-cap domestic equities had negative returns for that 10-year period. It's referred to as the lost decade for that part of the market. Now you look at the 10 years ended just the other day, June 30th of this year, and you see this reversion to the mean, this reversal. You see large cap domestic equities being the best performing and emerging markets the worst. So it doesn't work neatly every 10 years. You just can swap back and forth, but these rotations take place. Then, as I mentioned, and as this bottom chart would suggest, we're starting to see that happen with growth moving into value and large cap holdings losing some favor to small and mid cap. And this shows that small cap stocks, after periods of weak performance, have historically had very favorable performance. On page 35, as you will recall, we did some rebalancing in your portfolio in March. We talked about that at the last meeting, right at the when pretty much the market bottom, fortunately. A lot of advisors didn't do that. A lot of individual investors did just the opposite, pulled out of stocks, and what it probably will turn out to be a very unfavorable time. You could see that the big jump in money market funds that took place. Now, some of that's related to the savings rate that we discussed earlier, but a lot of it is also investor related, particularly when you look at money market versus cash deposits, bank deposits. So it's important to stay the course. The bottom chart there, many of you have seen something like this before. The S&P 500 for the 20 years ended December 31st of last year, averaged 6.1% return per year. If you miss just the 20 top days out of the 20-year period, you were basically a break even, a 0.1% return. So it's important to stay in the market. And then on page 36, we show not only do you have to stay in the market over the long haul, but how front-loaded the market recovery can be. So if you look at the top chart on page 36, the top line there that says staying fully invested under the 12-month category, you should be looking at a percentage that's 46%. What that's saying is that when the markets do recover, 46% of the market's recovery, average bull market lasts about 6.5 years. Almost half of the recovery occurs in the first 12 months. So staying the course, having a disciplined asset allocation, driving down your costs, staying diversified is our belief, our philosophy. That's what you've hired us to do. That's what we're doing for you. And so far, I think you're going to find relative to your peers that we're off to a good start. Any questions?
Okay. Any questions? Any questions? Jim, thank you for that thorough report. It was very good. Thank you.
See everyone. Stay well.
All right. Take care. Thank you.